Hello everyone, welcome to our Egyptian online seminar group. First, keep your phones off. Then if you have any questions, you can ask our speaker during his presentation. I have great pleasure of welcoming dear Professor Amir Amel-Zadeh. Amir Amel-Zadeh is Associate Professor of Accounting at Saïd Business School, Research Fellow at Green Templeton College, and Associate Member of the Oxford Man Institute Quantitative Finance. His research has been published in top-ranking journals such as Journal of Accounting and Economics, the Accounting Review of Accounting Studies, and Financial Analyst Journal. He currently serves as Associate Editor for the special issue on business and climate change at Management Science, and is on the editorial board of Accounting and Business Research. He was Assistant Professor at Jury Business School, University of Cambridge. He received his PhD and MPhil in finance from the University of Cambridge. Now we will start our seminar with the Professor Amir Amel-Zadeh.
Thank you, Mohammed. Thanks for the invitation to give a seminar, and thanks for everyone for joining. I can see everyone, quite a few names, so if you wish to ask questions, feel free to interrupt whenever you feel that we can make it interactive as possible. And of course, if you wish, you can also turn on your cameras and I can see you then as well. Great. So this is a project we've been working on for a while, but then kind of put it aside and now reviving it a bit. And it's still in an early stage, so there's quite a bit of work we can and should be doing on this. So any comments are very welcome in which direction you think we should take this. So this is a joint work with Jan Peter, Daniel, and Stephen. All three of them are at the Oxford Man Institute of Quantitative Finance here in Oxford. So this is a separate research institute, essentially funded by Man Group, the investment management firm, and mostly deploying kind of interdisciplinary work between engineers, computer scientists, and the business school and the econ department. So what we try to do here is essentially join forces between accounting and computer science and see whether we can apply some form of machine learning to a kind of traditional accounting problem, which is essentially financial statement analysis. And if you think of what we're actually trying to do is you use financial statement analysis to identify information in financial reports to essentially assess the value of a company. Now, and this is mostly done by fundamental analysts and fundamental investors, so kind of value investors, where they essentially use financial statement information to form their opinion of intrinsic value and then compare that to the market price to inform the investment decisions to whether to essentially go long or short in a particular investment. Now, in accounting, in the academic accounting literature, there's been kind of a fairly old literature on this in terms of whether information in financial statements actually explains or is able to forecast to be used in forecasting earnings or actually directly security returns. And this goes back to the 80s. And one of the kind of the seminal papers is this paper by Ewan Penman that essentially takes, that selects financial statement line item data and tries to predict essentially security returns. Now, this is fairly old literature. And the question then is, of course, if that's the case, if financial statement information can predict returns, then that would obviously violate semi-strong efficient markets. So essentially, the main motivation then is to see whether from essentially past historic available information we can predict companies' earnings power, and whether then we can predict how the market reacts to this earnings power. And there's been several evidence, and you might know this from kind of under the heading of the anomalies literature, the accounting anomalies literature. There's been some evidence on accruals being able to predict returns and other accounting information that is not impounded into security prices. Now, the question is whether we can then, if that's the case, whether we can apply some form of automated process or machine learning to this type of fundamental analysis, given that we only use essentially accounting information that is freely available and mostly in machine readable form. Can we essentially replace fundamental analysts by a machine and try to predict future earnings or security returns? And in a sense, this has been done already in engineering and decision sciences, where they've explored machine learning, but mostly for essentially financial market prediction. So not to use accounting information to predict returns, but mostly for time series prediction of stock returns. And the successes were kind of mediocre in that respect. But just recently in accounting, we have started to use machine learning for kind of different prediction problems, mostly related to financial reporting, so mostly related to fraud prediction or predicting misstatements. And another question is, can we explore this for fundamental analysis, particularly given, and this is the interesting question here, given that there's been quite a large interest over the last couple of years in applying machine learning to the investment process. And I mean, you just look at any investment manager, any large essentially asset manager, and they've been investing heavily into machine learning capabilities and trying to explore and exploit this. Now, and the reason why they do this and why we try to do this is that traditionally machine learning is essentially designed for pattern recognition and designed to do these prediction tasks. So it might actually could be applied successfully to fundamental analysis or to financial statement analysis, but we don't really know whether that's the case. And I'll explain why we would expect this to work in this case. Now, what do we do? So in this paper, essentially, we try to use machine learning. We use a variety of machine learning models, and I'll explain them in some more detail later on, essentially to predict now not earnings themselves, but we go directly to the market reaction to the earnings announcements.
I had a question.
Yes.
Yes, Ali, if you can.
I think you're on mute. Yeah.
Oh, sorry. I heard that you talk about the semi-strong form efficiency issues. So how do you, take care of it in your paper? Are you in support of the efficient market hypothesis and or against it? In this paper,
Well, I guess in a sense, our work here is an indirect test whether the semi-strong efficient market hypothesis holds, right? Because in a sense, if and we do find that these machine learning models work, and I'll show you some results on the returns and the abnormal returns on a trading strategy based on this. So in the sense, if a machine learning method works on past financial statement data, that would essentially violate semi-strong efficiency, right? Because in semi-strong efficient markets, you shouldn't be able to predict returns based on past financial statements. So that's essentially fundamentally a test, indirectly a test of this. Now, so essentially, we go directly to the market reaction to earnings announcements, and I'll tell you a little bit more about why we do this and why we look at earnings announcements and essentially the market reaction to those in particular. So we test a range of models, and we do this over kind of a large panel data set from 1990 to 2017, well, 2018 actually, but we need 1 year to for the prediction, and we use a variety of models. So we start with linear models, or OLS, the basic regression model, a lasso, which is essentially an OLS just penalized. So it applies a shrinkage estimator. And then we use random forest. And then more and more complex models, so a deep neural net and a recurrent neural net. And we'll go more into detail. So essentially, we apply some linear and nonlinear models, and the reason we do this is that there has been some evidence in the prior literature that essentially the earnings return relationship might actually be nonlinear, particularly in the extremes. So with extremes, earnings surprises them, there's nonlinearity. And if that's the case, then essentially nonlinear prediction models, so deep neural nets, might actually work better in that case. And in distinguishing ourselves from prior work in accounting in particular, and this is why we use machine learning here in this case, is we don't want to constrain ourselves to a selection of variables. In the sense, that's usually what you should do, right? You should have an economic theory why a variable works, or why you should use this in your prediction, and then test that in a statistical sense. But we essentially want to use the machine learning models to give us a selection of variables. So, which is why, as we name it here, we apply essentially a kitchen sink approach. We essentially throw in everything, all the variables that we can use from essentially the balance sheet, income statement, and cash flow statement, and then use the models to essentially select those variables that are most predictive in the training and later in validation or in the testing. So essentially, we let the machine or the models tell us what fundamental variables are important for the prediction of the market reaction. And then we go and look at whether those variables actually line up with economic theory. So we kind of go backwards in a sense, right? So, as I mentioned, machine learning models actually apply themselves quite well to this problem of financial statement analysis, because one, we have a highly dimensional problem here. So we have large data on financial statements that analysts can use to predict earnings, and there's different data items that give you information on the path of future earnings and dividends. And also because there's intertemporal dependencies, right? So you have dependencies of financial statements over time. So there's momentum in earnings, there's accruals that create momentum in earnings, that essentially the prior literature has found that analysts have difficulties disentangling, and difficulties in understanding the persistence of earnings and the persistence of the different components of earnings. So for example, Sloan in this seminal paper on the accruals anomaly has shown that analysts essentially project the accruals component in earnings to the future compared to the cash component, and obviously accruals essentially mean revert, and analysts underestimate this. So in applying machine learning, we might be able to essentially better understand these intertemporal dependencies, and these models might actually detect these dependencies over multiple quarters. So that's one. And then obviously the second point, as I mentioned, is that we can use these to reduce the dimensionality of this problem, and essentially select the variables that are most predictive or most informative in predicting future earnings and hence the future market reaction. So in a sense, if you were to throw in hundreds of variables in a regression model, you obviously are prone to an overfitting problem where you just throw in everything and something sticks. But these machine learning models are inherently designed to reduce this overfitting problem in the way that we apply either a shrinkage estimator or other nonlinear models. And then, as I also mentioned, another advantage is that we can essentially exploit these nonlinearities in essentially that relationship between unexpected earnings and abnormal returns, which would essentially suggest that nonlinear machine learning models would work better in predicting this return earnings relationship. Now, why do we use returns around earnings announcements? Well, one, if you think about what the underlying purpose of fundamental analysis is to uncover information that predicts returns. So the underlying premise is that market prices are actually not incorporating all the information that is included in financial statements. So, and that means that the market either under or overreacts to the information that is available, to the information set that is available. Now, when new information arrives to the market, and usually during an earnings announcement, investors then can essentially revise their cash flow expectations and correct the price, right? Correct the valuation of the firm. And this is what happens during an earnings announcement. So that's usually where most of the new information arrives in a quarter, and investors are then revising their earnings expectation and their cash flow expectation. So if you look at the prior literature, it's essentially, if you look at abnormal returns in a quarter of a firm, those abnormal returns, the majority of those abnormal returns is essentially clustered around the earnings announcement. So 80% of the returns of a quarter are essentially around the earnings announcement, which essentially is why we use the earnings announcement to explain that particular the abnormal returns. And then given that investors essentially revise their expectations based on the information arrival, then if these reactions are predictable, essentially based on past financial statement data, we should essentially be able to uncover this using machine learning, which essentially comes back to the previous question, as it makes this also an indirect test of efficient markets, and whether all the information that is in past financial statements is already impounded into in the earnings, and then in the market reaction to those earnings. So in a sense, if we don't find any predictability of the market reaction solely based on past financial statement information, then essentially all that information is already impounded prior to the arrival of the earnings news. And the second reason why we use earnings announcement is that in all these tests of essentially market efficiencies and anomalies, one criticism that we face, or an alternative explanation, is that it might not be an anomaly, so in a behavioral deficiency on part of the investors, that they over or underreact, but it might just be changes in essentially risk premia over time that we are essentially observing. And using essentially a short window around earnings announcement makes it less likely that we are inducing some form of measurement error related essentially to changes in risk premium. So if you think about asset pricing tests, you always have this problem that over time risk premium might change, and you're just picking up changes in the risk premium and not actually finding some new or some evidence of some behavioral bias. And using short event windows essentially reduces that risk to some extent. Now, I talked a little bit about the prior literature. So in accounting, we have used some recently, some authors have used machine learning to predict essentially bankruptcies or fraud and misstatements, and to some extent to forecast earnings, or to at least see whether analysts, what information analysts use in forecasting earnings. And there have been some studies, so the Frankel et al. Study has used some machine learning and natural language processing of earnings call transcripts to see whether analysts impound that information into their predictions. But generally, for fundamental analysis or financial statement analysis, essentially most models have been using kind of simple OLS or linear methods, and chosen the variables for those linear methods based on economic intuition, right? So which is particular predictive variables, so earnings to price ratios, and so on. So here we come in essentially using, as I said, the kitchen sink approach. So what do? So we take all balance sheet, income statement, and cash flow statement data, essentially from Compustat, right? So from Compustat North America, between 1990 and 2017. And so the quarterly data. So that's essentially just a raw database, right? So but if you look at this raw database, it's essentially about 1.5 million observations of so firm quarter observations, I should say, of around 27,000 firms, right? The problem is, if you do this and you look at the Compustat data, there's a lot of missing values, right? So if you just use the entire data set, there's some missing values for firms. There's changes in accounting rules where some variables essentially stop to exist. There's differences in sectors, so you have different measurements of particular underlying accounting concepts. So let's say for insurance companies and financial institutions, there's different measures that other sectors don't have. So you have this problem that you have a lot of missing values, and everyone who's worked with machine learning models knows that they don't really deal well with missing values. So we have to do something about this. So, and in particular in this Compustat data, about 63% of the values overall are missing, right? If you look at the entire database. So what do? So first, we constrain essentially the set to financial statement variables where at least 50% of the variables are non-missing during our sample period. And then we drop those where we don't have sales or asset data, which is essentially some anomalous data. And this is essentially what it looks like. So this is just a visualization of the entire Compustat database, where you have 720 variables overall. So it's variable 1 to 720. And the shading essentially over time here from the 1980s to essentially 2018, here, end of 2018, the shading tells you something about whether the variable is available or what fraction of that variable is available. So green is like 100% of the variable is available for all essentially observations for all firms. White is 50%, and then red is it's missing essentially. And you can see that over time, some new variables have come in, some have been abandoned, and obviously there's most likely cross-sectional, cross-sector differences, right? So this is a problem. So we essentially say, okay, we'll take those variables that are at least 50% available, but that doesn't help us either, right? So we need to do something about those missing variables. So what we then do is when we constrain this, we essentially have a selection of 121 balance sheet, cash flow statement, income statement variables. And for transparency, here the variables essentially item names from Compustat. So these are the most common items. So total assets, you have equity, you have liabilities, all the different liabilities, and then accounts receivable and so on from the balance sheet. From the cash flow statement, all the cash flows items, operating cash flows, and all the individual items from the cash flows, as well as the income statement, all the main variables such as sales and cost of goods sold, earnings per share, net income, and you name it. So these are kind of the main financial statement items. Now we normalize these to get rid of kind of size issues. We normalize the balance sheet items by total assets and all income and cash flow statement items by total sales. Now, still, even if you constrain the universe to only these 121 variables, there's still 23% of those are missing. So now a common strategy mostly in accounting and finance. So what we traditionally would do is we would just drop all those where there's missing values, because we can't use them in regressions, and only focus on available data, right? But in the machine learning literature, you would do a different strategy because you might otherwise lose a lot of observations that you could actually use for training these models. which essentially penalize these models. So you don't want to lose as much information. So what we do is we use an imputation method. So in our case, we use what is called soft impute. So it's a matrix factorization method, which is essentially, you can think of it as a singular value decomposition, or an imputation method that has been used mostly for or developed for recommender systems. So if you think of Netflix and the movie recommendations that you make, you usually don't provide your feedback. So how you have found a movie for most movies in the database. So what do is they impute what you theoretically would have given them as a rating for a movie based on how you have rated other movies, or based off how other customers who have similar tastes as you have rated those movies. All right, so it's imputed based on similarity, and we use this technique here as similarly in looking at within a particular sector, if a firm has a genuinely missing variable, so it's not a zero but it's missing, we use essentially the time series of the same firm as well as the cross-section within the same sector to impute that value. Now, we need to think about whether this imputation is sensible, right? So what we do is, to test the sensibility of this, is we randomly, for a select group of existing variables, we randomly delete data points, and then use the imputation method to impute those data points based on the existing values, and then compare the mean and standard deviation based on mean and standard deviation of the imputed values compared to the actual existing values. And it overlaps fairly well. So this is just for us to validate the imputation method actually works quite well. And one other issue is that when we impute values, we have to be careful that we don't use existing values of financial statement data that exist in the future, right? Because we want to use essentially our point-in-time financial statement data to predict returns at that point in time. We can only essentially use data available up to that calendar quarter, right, to impute any missing values. So we want to prevent essentially look-ahead bias, and that's kind of important in this case. Now, so this is essentially what we are left with. So we then have 121 variables.
Sorry, yeah. A question from.
Oh, there's a question. Yeah.
Okay. Yeah.
Hello, Professor Amel-Zadeh.
Yeah.
I'm amazed by the method of imputing the missing variables. So I have one question. So usually for the missing variables, are they because there was missing value in the financial statement, or because of the data collection part into the compute stat?
Yeah. So usually, we only look at, so if the data is not available, so if the company hasn't reported the data, that's fine, right? Because for some data items, a company might not report because it's like sector dependent, right? But we only impute those that potentially are some form of collection issue, right? So it seems like they're not available in CompuStat, but should have been available, or they are subsumed under different headings. And so to have a kind of a consistent time series of data, we need that data point. But it's still, so you're right, it's we need to be careful in that we're not imputing data for data items that should not have been genuinely not have been available, right?
Yeah, I'm also thinking if this data may be available somewhere, maybe in the SEC, we could go and confirm if there is algorithm can help us go to the website, find this company out and confirm the value there.
Yeah, that's a good idea, actually. We can have a look at maybe for a smaller subset, we take some of the missing values and see whether we can actually find them somewhere else and then compare the imputation method. That's a good validation method as well.
Oh, thank you.
Thank you. That's a good suggestion. Okay. Essentially, we left with roughly 500,000 firm quarters of 121 variables that we can now use to train the models for the prediction. Now, let me show you what we do. So we essentially use sliding windows of 5 quarters. So what we do is we essentially take 4 quarters of these 121 variables for each quarter, right? So that's essentially the 484 variables. So, and we use those to predict the market reaction to the earnings announcement in the next quarter. And then we move 1 quarter forward and use that quarter that we have predicted, now the newly available financial statement data for that quarter in the training as well to predict the next earnings announcement. So essentially, this ensures that we only use essentially past financial statement data, right, of the past 4 quarters to predict the earnings announcement in the next quarter, and not actually the financial statement data that is available in the contemporaneous quarter where the earnings announcement happened, because that data is not yet available to the markets, right? And then we move. So we train the data on 4 quarters. We then test it on the next quarter, right? And test the prediction accuracy on an unseen out of sample quarter, and then we use that test quarter for the next in training for the prediction of the next. So doing this, essentially what happens is that over time, as we move essentially from 1990 to 2017, the models have more and more data available, right? So they get more and more quarters that you can train them with to predict the next quarter and to use them for the test and sample in the next quarter. So that this might be an advantage, but also a disadvantage, because it's not clear whether using more data over time, generally you would think using more data to train models would improve the models, but because you're also further removed from the quarter that you're predicting, and we're not weighting these quarter information differently, you're essentially underweighting the most recent quarter for the prediction, the more data you're using. So it might actually reduce the predictive ability. So we've tried with some constrained models where we overweighted more recent quarters, didn't really improve the prediction. So we use the unconstrained. Now the earnings announcement, well, the reaction to the earnings announcement that we are predicting is essentially from -1, so from the day before the earnings announcement date to essentially 30 days after. So what we're capturing is the immediate market reaction, as well as what you usually know as the post-earnings announcement drift, right? So usually with positive earnings surprises, there's a positive drift after day 1 or 2, and with negative surprises, a negative drift, and we are capturing essentially those 30 days. So, as I mentioned, so this we use this expanding window approach, and to make sure that we essentially the test set that we're using to test the model, right, doesn't use any information that was available to train it. So the test data has to be out of sample, and in our case, it's out of sample and out of time, meaning it's always in the future. So, for example, if we are to use Q4 2008, right, to predict or to test the model in Q4 2008 for its prediction accuracy, we only use data up to Q3 2008, right? And then we evaluate the model in Q4 2008, and then for the prediction in Q1 2009, we use essentially also Q4 2008. So as we move along, as I mentioned.
Professor, I had a question.
Yeah.
This might not be related to this method part. In general, I was thinking that investors care about the stock price or stock return rather than whether the stock return or prediction of the stock return is coming from fundamental analysis or technical analysis. So given that there are existing literature on different market-based trading strategies like momentum strategies and others, you know better than me. Those are available. So wouldn't it be a good idea, or would it increase your accuracy using those market-based measures or variables in your fundamental analysis models?
Yeah, good question. Yeah. Yeah. So you can think of a variety of other information sets that you could actually use to increase the accuracy, right? So you could use analyst forecasts as well, or other essentially market, as you say, market-based. So essentially the risk factors. So what we do, I'll show you later in the test, we are controlling for those risk factors to see whether the model predictions provide information that is beyond what you would expect from those risk factors. So we do that, but we don't use these risk factors in the prediction models themselves, because what we want to see is whether just using financial statement data, nothing else, does that actually give us some prediction performance, right? Because theoretically it shouldn't, right?
Makes sense, yeah.
Yeah.
Thank you.
All right, so I'm not going to go into detail into these models, but so what we use is essentially a deep neural net as one of the nonlinear models, and essentially it has 3 hidden layers and 1 input layer. So as I said, we use 4 quarters of data. Each quarter has 121 data points. So it's essentially 484 data points essentially stacked, right, as input to that neural net, and has essentially 150 and then 33 hidden units in each of the layers to and ELU as an activation function. So essentially, if you were to look at this neural net, it looks something like this, right? So you have this vector of dimension 484, and then you have essentially 100 neurons, 50 neurons, and 33 neurons, and you reduce them dimensions in each of these layers as we go training the weights. So in training, you're training the weights of essentially each of these steps until you get to that prediction. So that's a neural network. We use a recurrent neural net. So the difference between these is that in the recurrent neural net, you not only have essentially a sequential, you not only essentially add all the temporal data as one, so you essentially lose the temporal dimension of the data here, because you're just feeding in every data point at once into this model without taking into account whether it comes from quarter 1, so the most immediate quarter, or the 4th quarter. So the recurrent neural net has a temporal dimension, right? So you move over time, so you can feed in the information of the 4 quarters sequentially, and also then use essentially these gates to have information flow from the past quarter to the next quarter to improve essentially the prediction accuracy, or theoretically improve the prediction accuracy by essentially having information that is shared from past quarters, so the earlier quarters, feed forward to the later quarters as well. Then we use a random forest, so it's essentially a kind of a regression trees with multiple regressions. We use 200 trees per forest and 10 splits. So you can use more, but the more splits you use, so the deeper the forest gets, the more prone you are to overfitting, because you just making sure that the prediction is essentially very fine, right? And then we use these linear models, so a lasso and an OLS regression. So the only difference between OLS and lasso is that lasso has this additional constraint that you are adding in the optimization. You're adding essentially in a penalization factor that pushes down the coefficients to essentially to 0, so that you lose more and more of the predictor variables that have very low predictive power, and so to essentially reduce overfitting issues. All right, so using these, let me go back here. So using these different models, you then have to have a method to evaluate these models, right? So how good these models are actually in their prediction, given that this is a regression problem. So maybe I should have mentioned that before. So what we do is we want to predict the market reaction, which means we are predicting essentially the sign, but also the magnitude of the reaction. So we have a continuous variable that we are predicting, which makes the prediction problem a little bit more difficult, because generally these, particularly these neural networks, work well in predicting essentially a dichotomous outcome, right? So 1, 0. So we could have done this. So we could have just said, okay, let's predict a positive or negative market reaction. But we wanted to also see whether we can predict essentially the magnitude of the reaction, which now means that we have a regression problem, which means that in evaluating this, we have to think about how we can use essentially a mean squared error, which you generally use, but it's difficult to interpret the mean squared error. If you have a low mean squared error, what does it mean in terms of how well your prediction actually works? So what we do is, in addition to the mean squared error, so what we use is a metric that we call percentage correct. So we've developed this metric just for this purpose. In what we do is we look at different thresholds of the magnitude of the reaction. So think about the earnings announcement. So the earnings come out and the market reacts. If it's a big surprise, the market reaction might be 10%, might be 20%, might be 40%, right? Very extreme, or might be around 0. So what we do is we look at these different thresholds. So 0 to 5%, 5 to 10, 10 to 20, 20 to 30, and then see whether our prediction is at least correct in landing in within those thresholds. So if the market, the actual market reaction was, let's say, 12%, and our prediction model predicts 15%, we would still this would still count as a correct prediction because it falls within that band of between 10 and 20. If the actual market reaction is 12%, but we only predict 5%, then this would be incorrect. So in this way, we can have essentially a dichotomous prediction outcome where we either correct or incorrect in predicting the magnitude of the reaction and the sign within a given threshold, right? If you're above that, a given threshold. And that's essentially what this percentage correct metric predicts. Just to tell you, just to show you how big these markets, so what the distribution of these market reaction is. So the epsilon here is essentially the magnitude of these actual market reactions. So above 0, above, well, it's here, this is the absolute values, right? So above 0 up to 0.5, so up to 5% on either side, right? Plus 5%, minus 5% market reaction, plus 10%, minus 10%, and so on. So essentially, of all of our data, so the 545,000 observations that we have, obviously all of them are included in either they're above 0 or below 0 to some extent, right? But if you look at the really extreme ones, so 50% plus or minus, so the extreme market reaction to the earnings announcement, we roughly have 25,000 of those. So there's 25,000, so around 5% of the observations of the earnings announcement that we observe have a really extreme 50% plus market reaction. And around half of our observations have at least 10% or more, right? So 10% above or minus 10% in reaction. So fairly extreme. So this again tells you that it might make sense to look at earnings announcements because there's such an extreme reaction to those, that a lot of new information comes in. So we make use of those. So this is just the performance of these models. So we have essentially the random forest, deep neural net, recurrent neural net, lasso, and OLS, and this is the mean squared error and the root mean squared error. So what we see here, just from the basic error metrics, is that it looks like there's not that much of a big difference between the non-linear models compared to the linear ones. So there's some, right? But if you look at lasso, for example, with random forest, they both have the lowest mean squared error. So seem to be performing fairly similar, right? which is kind of surprising because we would have expected these more complex models to perform better. But that doesn't give us the full picture. So if you look at the percentage correct, right? So here, this gives you the average correctly predicted market reactions within those thresholds, right? So this is for the random forest, the deep neural net, the recurrent net, the lasso and OLS. And this is for the thresholds, so the magnitude of the reactions in the columns. So if you look at random forest, the further you go up, at least up to the market reaction of 30%, you get 59 on average. You get a prediction accuracy of 59%. It's not very high, right? But it is higher than non-random. So on average, you are actually correct in predicting market reactions of 30% or more, which is better than predicting essentially all of the reactions, right? If you look at the other nonlinear models, they also increase in their prediction accuracy. They're hardly, to some extent, hardly better than random at the low range, but in more, they get better at predicting more extreme reactions. If you look at the linear models, though, the linear models seem more accurate in predicting essentially the lower market reactions, and they get worse for the more extreme ones, which is actually in line with what we expected from the prior literature that has shown that in the extreme tails of earnings, and so that earnings return relationship is actually nonlinear in the extreme tails. And this is what is consistent with this, that the nonlinear models are better in predicting those extreme reactions versus the linear models that are better in predicting the less extreme reactions. But overall, there's not that much of a difference, right? In terms of the prediction accuracy, maybe with the exception for the random forest, and we'll come back to that model in a second. This is just visualizing this again in terms of returns. So what the average overall returns are if you now use these predictions to make devise an investment strategy. So essentially what we're doing here is using essentially whatever the models predict what the market reaction would be in the next quarter. If they predict a positive one, you go long in those assets. If they predict a negative one, you go short, and then we hold these for 30 days. You hold the stocks for 30 days, and then next quarter you reshuffle based on the new earnings announcement that come in and based on the new predictions. And so there's always a long and a short portfolio. And depending on the different thresholds that you're predicting, so if you're predicting all of the earnings announcements, then you're holding a lot of stocks, right? So that's there's a lot of trading going on, and compared to if you're predicting only the extreme market reactions. So, and this is essentially what this shows, right? So this shows the average return of these models over the market reactions that you are predicting. So you can see here lasso and OLS actually generate negative returns for predicting extreme market reactions, while the nonlinear models are actually much better. And as with the accuracy performance, it's the random forest essentially produces the highest returns based on predicting kind of moderate to high market reactions. What these graphs here show you for the different models is the average return, but also in the shaded blue area, the standard deviations, so the uncertainty around these, given that we have essentially multiple observations, so per quarter for all the firms, right? In the cross-section, we can essentially look at the average accuracy, but also the uncertainty around how good these models are on average in predicting these market reactions. And you can see that there's a lot of uncertainty around the lasso, so and around some of the nonlinear models, whereas the recurrent neural net is actually, the standard deviation is much smaller, so much lower volatility around the prediction for this. And I'll come back to this later. This kind of reflects in the investment performance. So here, let's look at the investment performance. So here, just you have taken essentially just two of the different thresholds that we're predicting. So this is essentially predicting a market return of 30%, right? So the models are here now saying, okay, whenever we are predicting more than 30%, or market reaction to the earnings announcement of 30% or more, or minus 30%, then essentially go long in that asset or go short, and then hold that for 1 month and see what the return is, and go and then rebalance that portfolio every quarter when new announcements come out. So this is the performance here, right? So you can see the raw return, the volatility, and then obviously the Sharpe ratio of these, the maximum drawdown, the beta of those portfolios, and then the alphas and how many trades you have done. So you can see here that in terms of the returns, the nonlinear models have significantly higher, generate significantly higher raw returns, and also the significantly higher alphas. And again, the random forest seems to work the best with the 3 factors. These are annualized alphas of 25%, which is quite high. And you can see that the neural nets have much less volatility, as shown before. So the maximum drawdown of these portfolios is much less, which also is reflected in the Sharpe ratios. So much higher Sharpe ratios, even though the returns are lower than the random forest, for example. But because the volatility of those predictions and the volatility of those portfolio returns is also lower, the Sharpe ratio is higher, right? Now, this looks at how many trades these models essentially do based on the prediction. And you can see this gives you an indication of the transaction costs that you would incur. Kind of seems reasonable for these models. The recurrent neural net just trades too much, right? There's 1,000 trades per year. Even based on these kind of returns would probably not be feasible in practice, right? Now, to come back to one of the comments that we had is, so what about, does this actually provide more information? So does the analysis of fundamental data from the financial statements actually provide information in excess of what you would expect given essentially risk factors, right? So do we explain more just based on these different models? And here you can see, so we're using essentially the size factor, the value factor, momentum, profitability, and then some value-based factors as well. So this is dividend to price, earnings to price, accruals, and liquidity as well. And what would we expect? So given that we're using a fundamental strategy, so a value-based strategy, we would expect the value factor to load, right? And we would expect probably something like some of these other value-based factors to load, as well as accruals. And this is essentially what we find, right? So the value factor loads essentially in all of these regressions. The size factor loads, which essentially tells us that most of the, or a lot of the return performance comes from smaller firms. And I'll show you some evidence later on as well. And essentially the accrual factor seems to load as well. But given here, so this is the alpha, the constant. So controlling for all these risk factors, you can see that there's nothing left if you use OLS or lasso. But if you, with the recurrent neural net, the DNN and the random forest, the alpha is still 4%, 5%, and 6.5% for these extreme reactions, like 30% reactions, and it's highly significant. So even controlling for risk factors, the model seems to be able to make predictions and selecting stocks that that essentially outperform, where the portfolio of these stocks essentially outperforms these risk factors. which is surprising again, which is surprising given that we're only using essentially just raw past financial statement data. We're not even using ratios. We're just using the raw data, and we are relying on the neural networks in the hidden layers to essentially form those ratios themselves, right? So because they use combinations, nonlinear combinations of these variables. So theoretically, they would be using some form of ratios. Now, the interesting part now is we want to understand, okay, what are these models actually doing? So one of the problems with machine learning models is it's kind of a black box, right? You don't really know in these neural networks what kind of nonlinear combinations are being put together in those hidden layers that get us to this best prediction. And so what we can do, though, is the random forest allows us to essentially calculate what the most predictive variables are that the random forest uses in the predictions. And so we'll do that next. But before, just to show you how over time, so here I've shown you essentially quarterly average alphas, right? But how over time that actually decays, right? So if you were to, this is the model performances from essentially the early 1990s to 2000, then from 2001 to 2009, and then from 2010 to 2017. And you can see how the slope kind of gradually declines, which essentially tells us that, that the market becomes more and more efficient over time. And there's less and less predictability of in essentially past financial statement data as you move over time. It might also have to do with essentially what I told you before, that given that the models use more and more data, maybe essentially it puts too little weight on more recent data and too much weight on the more historic data, in which essentially reduces model performance. But this is kind of quite interesting to see, and somewhat consistent to see that there is this decay in alpha. Now, so coming to this economic interpretation, we can essentially calculate an importance measure. So the random forest allows us to calculate an importance measure, which we average across all the predictions to tell us, okay, what kind of variables are the most important in the prediction of the market reaction. And this is essentially what we plot here. So overall importance and by quarter, right? And look at this. So the most important variable is change in accounts receivable, right? Cash, change in inventory, change in accounts payable, change in other assets, capital expenditures, and working capital. So if you look at these variables, those are exactly the variables that you would expect to use in forecasting free cash flows, right? So what do we do in forecasting? An analyst that forecast free cash flows, what do? They use operating income, do some tax adjustments, right? And then they add or subtract changes in working capital and capex. And that's exactly what we have here, right? So it seems that the model actually picked those variables that economically we would expect that would predict future free cash flows. And if you look at this panel B here, what relative quarter these models use, or here in this case, the random forest. So we're feeding in past 4 quarters, right? So the most predictive come from the past 1 quarter and past 4th quarter. So essentially, what these models do is, or the random forest here does, is put more weight on essentially quarter-on-quarter comparison and year-on-year comparison, what essentially financial analysts also do. They also make most recent quarter comparisons or year-on-year comparisons to look at seasonalities, and that's exactly what these models also seem to be looking at. So, which is kind of interesting that essentially just throwing in like these raw variables and not determining what variable combinations to use, the random forest essentially uses exactly what is expected, what you would expect to be predictive of future free cash flows, and what you would expect in terms of the relative time periods to be more informative in terms of past quarter and past year information. And that's essentially pretty much what we do. So we essentially use these nonlinear models, and if you look at the forecast errors and essentially prediction accuracy, it's actually not that high, right? But still, even a 59% prediction accuracy gives you quite high investment returns if those returns are fairly large, right? And you've seen that the random forest model actually was better in predicting fairly large magnitudes of returns. So if you are able to predict those types of returns, you can actually, in a trading strategy, generate fairly large investment returns, even if your prediction accuracy is fairly low. But whenever you're right, you're really right? And it seems that from the random forest, we can tell that these models are using essentially time series and cross-sectional properties of earnings, so accruals, asset growth, capex, cash flows, and dividends to make these predictions and make these year-on-year and quarter-on-quarter comparisons, which is quite surprising. So, and that's essentially the purpose of the paper, right? To do a first exploration, essentially, of whether machine learning can actually be used in financial statement analysis, and just trying to understand if we are adding just financial statement data, raw financial statement data, whether there's some prediction performance of these models, which ex ante, so our null hypothesis was that it wouldn't be. But surprisingly, we find some prediction accuracy, and that even more surprisingly, that these models actually reflect some underlying economic intuition that you would expect. And it's also consistent with nonlinear models working better on more extreme market reactions versus the linear one that are working better on the more moderate market reactions. So overall, essentially, this also shows that even though over time there seems to be the market seems to be much more efficient in terms of using past financial statement data as impounded into share prices, into quarterly earnings announcements, we still find some predictive ability even in the later periods. So I'll leave it at that. And I see there has been a fairly long question. I didn't have time to read it while talking, but I can have a look at that and try to answer that. Anna had a question. Maybe Anita would be trying rolling window for every quarter and comparing to your. Oh yeah, so that's something true. That's something that we have thought about as well. So instead of essentially expanding the window, we could only use essentially a 4-quarter window and move that 4-quarter window forward without using the past quarters to see whether that would improve prediction accuracy, because we would then underweight essentially, or weight those past quarters with 0, right? I think that's right, and that's right. So the second part of your question essentially relates to it would be difficult to conceive that, let's say, data from 1990 would be useful in predicting earnings or the market reaction to earnings in 2017, for example. But that's not exactly what we do, right? So we still use this moving window of 4 quarters of the 4 most recent quarters to make the prediction. But to train the models in making those predictions, we use essentially a larger data set as you move forward. Right? So you only use 4 quarters to make the prediction, but you train essentially the model weights when they're making these predictions using more and more of those 4 rolling windows. So instead of just using essentially, let's say for 10 firms, using 40 4-quarter rolling windows, you use essentially 400 4-quarter rolling windows, because you use them also from the past quarters. So that's essentially how we use the data. So just
question from Professor Samir Tawalki.
Yeah. Yeah.
Great paper, Amir, as
Thank you.
usual. Yeah. Look, I really like the paper. I have a question here, which is really a fundamental question. You know, there has been a trend in the bankruptcy literature, fundamental analysis literature, where we do compare parametric model to non-parametric model. And now with the progress in machine learning, I do some work on machine learning. I see that the new trend is compare. Now we're going to go to another layer of comparison, which we're going to put those non-parametric model and parametric model to their maybe do they have higher prediction power, lower prediction power than these machine learning techniques. Now, first, what's the value added of that? And then I didn't read the paper, but I mean, what's the contribution for decision making? What's the value? What's the incremental value added of all of this?
And let me take the second question first. So essentially, the way we approach this problem is to find out whether, given that you in fundamental analysis you are essentially dissecting information from financial statements, whether you actually need a human analyst for this, right? I mean, ultimately that's the question, and whether machine learning methods that use nonlinear combinations of the data can actually make potentially better predictions as human analysts, because that's essentially what we're doing, because we're comparing what the market does with this model, right? And it seems that there's still some predictive ability now, although decaying over time, right? So essentially that's the contribution, is to understand whether financial statement analysis could be automated, right? In a sense, if you think so, from a decision-making perspective, if you want to think so. From the accounting literature perspective, is essentially we had this kind of earlier literature that showed that there's these accounting variables that predict returns, right? And this is based on the notion that analysts and investors don't maybe have information extraction costs and don't really extract that information or can't interpret that information correctly. And we just essentially add to that literature and show that even the basic information, so the basic financial statement information, is still not fully impounded into share prices, particularly for extreme market reaction, which I find surprising, right? I would think that all or most past financial statement data is already impounded into the share prices. To your first question on combinations of different models, right? I think generally and this was with this paper as well, which is why I kind of co-authored with my computer scientists, which were very excited about this. I was a bit more skeptical in using machine learning for capital market prediction. I think particularly from an academic standpoint, in reading the literature, actually, it's very difficult to predict market prices. So if you look at kind of asset pricing predictions, like long-term returns, it's like almost impossible, right? Which is why we looked at these extreme reactions in earnings announcement. But I think there is something to say in terms of combinations of different modeling techniques, not necessarily to make predictions, which I think for academic research is less interesting. For practical purposes, of course, I mean, asset managers are very interested in this, but I think more so to understand underlying relationships a bit better and if we do this, to maybe come up with better proxies for certain variables. So I'm more comfortable with using machine learning, right, to generate better proxies that we can then use to test particular theories, right?
Yeah. Now, on the, is there time for a follow-up question, Mohammed?
Sure.
Okay. You know, on the benefit side, have you done, I mean, again, sorry for, I didn't read the paper. Have you done buy and hold, and you compare machine learning to the other technique? Have you done that?
No. So that's a good point. So what we could do is, so you're saying just a simple buy and hold? Absolutely.
And my prediction, honestly, with the results I saw, is, you know, it's going to be using machine learning. We're going to have better, we're going to say whether the buy and hold strategy is accurate, you know. Yeah. Maybe those non-parametric model, parametric model, OLS, you know, they're subject to multicollinearity. There is, you know, so there is many problems that make the buy and hold strategy noisy. And that's where you're going to show this is really useful for investors. You know?
Yeah, I think, and to some extent, that this was the purpose, right, of the paper, because you can't essentially use that many variables in those other models, because it's just you overfit. There's like multicollinearities. There's a host of other problems. You know, the missing data is another problem, and so on, right? So it's essentially the question that we were interested in is, can we essentially use a fuller set of information that is available to make investment decisions, right? But you're right, the next step is potentially to benchmark these models against some other model, right? And the simpler benchmark would be we use the earlier papers, the Wu and Penman, that just use a simple logistic regression with a bunch of variables, right? And make these predictions as a benchmark and see whether that works or not. I think that's a very good
anyway
idea.
It's really good.
Thank you. Thanks for the points.
Question from Lou.
Hey.
Professor Amir-Zadeh, thank you for the great presentation. So I have a question regarding the practical world and our academic world. So in the I know you are very tied to practical world too, because I saw your paper about survey them, right, to get the perspective from the institutional investors. So for them, they're already using this machine learning algorithm to do the prediction. I can imagine they use the fundamentals to predict the future earnings. I also read a paper about a fraud detection. They use ensemble learning to do fraud detection to see this model is better than logistic and the support vector machine. So my question here is that if the practitioner or they're already using machine learning to predict, then why academic world do it again? What's the purpose here?
Well, I mean, to some extent, you would think if in practice it's already been used, right? And I'm pretty sure there are asset managers that are using machine learning, but probably not. There's still a lot of fundamental analysts and fundamental investment managers. So probably mostly the quant funds use this, right? Use machine learning. And this goes to Fabio's comment as well. Kind of this goes in, is consistent with what we find, right? With the decay over time, because the quant funds, there's an increase in downloads of data and automated analysis of these data. So I think that's all in line. The question still is, I think from an academic perspective, is we don't really know what they do in practice, right? And whether it works, because obviously this is all a black box, and whether and what these models do. So for us, it was, and that's why we use the random forest as one of the models. It was interesting to see, even if you find predictive performance, because academically that's not that interesting because it doesn't explain any theory. But even if you find a predictive performance, can we then see whether those predictors are in line with what we would expect economically? Right, and that's the interesting part. So we're trying to get more into explaining why these models work, if they work, or what they actually do. Now, I've been a bit too enthusiastic in saying why these models work, because we don't really know why they work, because to me it's still surprising why a simple, essentially using simple variables that explain free cash flows would explain market reactions, right? But I think there's still it's still academically interesting to analyze these models. And it's kind of I would call the interplay between practice and academia, right? So there's some practical applications, or how practice is using or making decisions, that is interesting from an academic perspective to understand why they're doing so and why it works. I think, at least for me.
Yeah, and another question is that so for a lot of accounting issues, we are trying to interpret which factor affects which factor, and some other issue like the one you are doing now is forecasting. So I'm thinking, is there really big difference between explaining and forecasting? Because the reason we want to explain it is because we want to know what will happen in the future. This is why we want to explain, right?
That's right. Yeah, I think, yeah, so there's a connection between the two, right? But it's not necessarily always, so one is not necessarily always sufficient for the other, right? Because if you're able to forecast something, doesn't mean that you are able to explain why it works. And in other terms, if you can explain something, it doesn't mean that you're able to forecast, because you might just essentially overfit to your sample, right? And it doesn't work in going forward. But there is obviously the connection. You're right. It's definitely. Fabio made a comment. Maybe the models are capturing what on average analysts do, and then we have this Keynes beauty. I think that's right, and that would be an interesting comparison as well. So, and we thought about whether we should include analyst forecast or use analyst recommendations as a benchmark as well, right? So look at their recommendation, and then essentially compare the trading strategy based on essentially the machine's recommendation versus analysts, and that would be an interesting benchmark to use as well. As I said, there's still a lot to do on this. It's more or less exploratory at this point, but I think there's a couple of avenues and there's a couple of good comments that I can take back and look into.
If anyone have any questions, you can open your mic and ask your coach.
Yeah, feel free to shoot. Or if you have anything else you've seen somewhere, any other papers that are similar, or. All right, there's another one. Chi-Young says, is there any possibility that your machine learning model result can be related to psychology or behavioral finance? Yeah, it's a good question. To some extent, right? So that comes back to explaining why the model works, right? So let's say you have, we find this essentially that the trading strategies generate abnormal returns. The question then is, why is this the case? So is this because, so the market obviously doesn't then impound all the available information in past financial statements into prices. Is this because there are limits to arbitrage, right? So in a sense, there's transaction costs, there are other information retrieval costs that make this prohibitive. And we allude to this to a little bit because some of the models do a lot of trading to generate those returns, and it would probably not be economically feasible because the transaction costs from the heavy trading would just eat up all the returns that you can get. So in that sense, there might be some explanations, right? The transaction cost explanation, or it might be a behavioral or psychological explanation that is just difficult to extract all the information and to analyze all the temporal and nonlinear relationships between all the variables that give you the best prediction for that quarter, which humans can potentially not do, which is why the machine generates those. That would be the behavioral explanation. But I mean, we would need to look into this a bit more in detail. So here has a question about kappa and beta in the models. I'm not quite sure what that relates to, but essentially what we do is, so generally, what you do when you essentially do kind of an anomalies or an asset pricing test is that you estimate essentially the other factors and then throw them into your regressions to test whether your factor or your abnormal return still holds controlling for all the other risk factors that we know explain some of the returns, such as the value or size or others. And as do you assume in your paper that the investor is rational? Well, I guess as the null hypothesis, we would, yeah. So that's essentially the null is assuming the investors are rational and impound all the information. We necessarily see any predictive power, right? And then we can use this as our benchmark. Fabio, could you be checking differences between institutional health firms? That would be interesting. So in a sense, you were saying that let's look at whether institutional investors are more rational or have more resources to use essentially computer models to make their investment decisions. And maybe for firms that have higher institutional ownership, the model predictions actually don't generate as high of returns as for those where there's less institutional ownership. We can look at that, right? So in a sense, that goes back to distinguishing between assets for which the market is more efficient compared to those for which it's less. To some extent, I haven't presented it. It's in the paper. We have looked at this in looking at firm size, right? And we essentially tested, because we saw that the size factor loaded quite heavily in the asset pricing regressions. So we looked at different size thresholds and looked at the predictions. So what happens if we exclude the smallest firms from our sample, run the predictions again, what's the model performance, right, compared to the entire universe? And you can see, it's in the paper, the performance actually is significantly reduced. So a large fraction of the performance comes from smaller firms, which tells me, again, is consistent with Fabio's notion that it's those are the firms where it's more likely that some of the information is not already impounded, and because they have less analysts following, less institutional investment, and so on. So that's roughly in line.
Question from Dr. Marwa.
Yeah.
Nahas.
Hi, Amir. Nice to meet you. It's Marwa from Newcastle University. I'm still learning about machine learning, actually. And I wonder, do you think these type of models, since it captures the valuation aspects, can they actually be used for stock market valuation rather than market reaction? Also, models has been quite historical, and we know the problems of using Olson. But what are your thoughts about actually applying these for stock market predictions?
Yeah, I think it's going to be difficult, I think, in terms of using these to essentially predict market prices, in a sense, right? And the reason why I think this is it's because prices are a lot more noisy, right? In a sense, because there's a lot of information that is impounded in prices on a daily basis, but there's also a lot of noise coming from liquidity trading, coming from all sorts of other sources, right? So I think it would be very difficult, and this kind of is reflected in, if you look at some of the older papers that use machine learning to predict prices or returns, the prediction accuracy is fairly low. It's very difficult. Now, having said that, there might be a case to use machine learning models or some nonlinear model to improve on, let's say, the Olsen model, right? Or some value relevance models in terms of looking at the relationship between balance sheet values and market prices over longer time periods. So not essentially daily returns or daily prices, but predicting, let's say, annual market values, right, on an annual basis. That might be more feasible, but I'm not sure. I think it's very difficult to use machine learning models on essentially market data.
Okay, perfect. Can I get another question, please? Just quickly, do you think there are any way that you could consider impact of governance among these type of modeling for like controls or to control for governance aspects and internal control aspects as well as auditor implication across these machine learning models?
I'm sure, yeah, you could essentially, if you think of what we've done is essentially just use financial statement data. Like, you could augment, in a sense, the information set, and theoretically, the model should improve in their prediction the more information, the more uncorrelated information they have, right? So whether it's from analyst forecast, whether it's from other market sources, you could think of governance data or audit reports, audit opinions, or even textual data, right? So we could also feed in essentially some textual measures that have been shown to predict returns and see whether that improves. And I would expect, ex ante, I would expect it to improve model performance. But I mean, it might increase noise, I don't know, but you can see theoretically it should improve. You're right.
Thank you so much, Amir. It's a lovely presentation and nice to meet you. Thank you.
Nice to meet you too. Hope to see some of you at some point, either in the UK or at some conference somewhere. So it was great having you. And I'll pass back on to Mohammed.
Yeah. Are there another question? If anyone have any questions, you can open your mic and ask your question.
I think that is it. It's also good on time.
No.
Okay.
No.
Could I ask one more question?
One last question.
I could catch you in this meeting.
Sure,
I know you're also an expert in CSR issues. What's your perspective on applying machine learning on investigating CSR issues?
It's a good question, and I think there's some value in that, right? In the sense that, well, there's a value and there's a problem. So with machine learning, you need a lot of data, right? So, and we don't really have that much CSR or ESG data or good quality data at the moment, right? So there's more data points coming in. So that might be a problem, but I think there's something to say in using machine learning, and I include under machine learning also natural language processing, right? Because they use machine learning models essentially as well to CSR problems, especially because we don't have the data, right? So essentially you're generating new data points using machine learning from the disclosures, from the firm disclosures, and that would be useful. So whether it's applying tax analysis to sustainability reports or trying to understand certain, I don't know, within the firms, right? So they could try to understand or detect patterns of particular pollution patterns, or you use satellite images of pollution patterns, and you could use that for analysis. So I think there's quite a lot of applications that you can do in that area that would be interesting, but it's still early days. But very good.
Yeah, thank you for the great insight. I look forward to more presentation from you.
Thank you. I look forward to seeing all of you. I think it's good timing. It's 4:30 here. I have to jump on another meeting and another call, but it was very good to see everyone. I'm just reading all the questions here. Yeah, we are. So the paper is out on SSRN, and once we have published it, we will make all the code and data and the computer data we can't make available. We will make available the code and in more details on how we put together the models, so that people can replicate as well.
Thank you very much, dear Professor Amir Amel-Zadeh, for your contribution and your effort. It's really an excellent presentation and excellent paper. Thank you very much. And it's all that remains for me to say is thank you everyone that joined us, and I thank you very much for taking the time out to present to us today, dear Professor Amir. It's been really appreciated. Thank you very much.
Thank you. Thanks everyone. Thanks.
And I hope to see you soon in Egypt. You are very, very welcome.
Thank you. I will try to come and visit. Thanks very much.